Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Are you wondering how to build trust between you and your investors? The InvestNext Portal houses everything you need to raise capital online, deliver professional reporting, process distributions, and more. When booking a demo at investnext.com, enter promo code Whitney for 15% off your first 3 months. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Michael Episcope. Thanks for being back on the show, Michael.
Thank you for having me, Whitney.
Yeah, I know Michael and I discussed strengthening investor relations to scale your business and scaling your syndication business on May the 25th. I encourage you to go back and listen to that show. But Michael has lots of skill sets in this business. They've grown an amazing brand and business in this, just in the syndication space, and has many things we're going to discuss today, but specifically about funds and how they have structured funds, how they operate funds, and just giving us some advice there from his expertise. But a little about him in case you missed the last show. He's a principal of Origin Investments, co-chairs the investment committee, and oversees investor relations, marketing, and company operations. He brings 25 years of investment and risk management experience to the company and believes that calculated risk-taking in inefficient markets is the key to building wealth. Michael, again, welcome back to the show. Why don't you just give us I'm going to encourage the listeners to go back and listen to your other show because there was so much value into that as well. And I know so many are going to want to hear as they're growing their syndication brand and business and working and scaling their business, working with investors. But why don't you just at a high level talk about funds a little bit, how you all, what you are using funds for now. And then let's dive into some of the details of how you all pick maybe certain types of funds or structure them.
Sure, absolutely. Yeah, I want to comment too, because it's funny hearing you read my bio there and calculated risk taking. What that really comes down to is the rule number one: don't lose money in investing, and that's what it's about. We've been investing since 2007. That's when my partner and I started the firm, and it was very quickly that we decided to structure things as a fund, and a little bit different than a lot of syndicators out there and things. And the reason why we did that was we just believe it's a better way to invest. It's better for us as managers, and I'll get into that, but it's also a better way for investors to invest as well because it provides diversification. Fund is really like a company as well. And you think about the managers promote, and when you do individual deals, the managers promote is not cross collateralized, meaning if you do great on one deal, the manager is going to get paid. If you don't do well on another deal, the manager won't get paid, but net, they do get paid on those deals. So in a fund, all of those promotes are performance fees are cross collateralized into one. So when we're really thinking about adding deals to the fund, there's a lot of time and effort and discipline that goes into that. And our whole team is compensated through the fund structure as well. So we have a credit committee that goes well beyond my partner and I. It's also all the team members who have a vested interest in the fund. And when people bring deals to committee, when our acquisition officers do, those are scrutinized, and they're heavily scrutinized because the wrong deal can taint the entire fund. So from a discipline standpoint, there's a much higher bar for what gets into the fund, because when you have $200 or $300 million in a single fund and one deal has the potential to kind of bring the whole thing down and bring you below that preferred return, it's a different threshold. And then when I say it's better for us as managers, what I mean by that, I'm sure most people's minds are going to the fees. The fees are actually not any different. So we charge an asset management fee. In most cases, you're going to get that on a syndication. We'll either charge a committed fee on that capital or an acquisition fee, and you're going to get those same things on syndications as well. But for us, when we're going out to the market and we're competing for deals, the biggest thing is proving that you have capital. And when you come to the table and you are one of 3, one of 5, one of 10 investors who are looking at a deal, and the seller is trying to qualify you, and somebody's coming, well, we don't actually have the capital but we can close, trust us. That's not as good of a story as saying, look, we've got a $200 million fund and we can close in 30 days. And in today's market, that's incredibly important to have that advantage to be able to close quickly, use the fund capital, knowing that you have investors there who are ready to write a check for a deal that's approved within a box itself. So there are a multitude of advantages to a fund. I know some people don't like to give up that control. They like to actually pick and choose their deals. But I think understanding the benefits, the pros and cons of both is really, really important. And the last thing I would add is sometimes it's not an or, it's an and. So we actually, in our funds, tend to use sidecar vehicles. So for deals that maybe are too big for the fund, if we're only going to put $15 million of equity into the fund, but the deal requires $25 million, that $10 million then goes to investors in a sidecar vehicle to fund investors, generally at more favorable fees, so they can invest in that deal. And they can know, investing in that deal, that this has already been vetted by us, by the fund managers. This is something that we're putting into the fund. So it really shortcuts that, because you've already made the decision to invest with us, with Origin, in this fund. It most likely fits your risk profile. So those are actually advantages as well when it comes to even when we're syndicating side deals and participating in individual deals.
So incredible there. I mean, you answered so many of my questions before I even asked them, which is great. But while you're talking about sidecars, it's something I've heard a lot more about recently. And I think as more people are looking into fund structures and how to do this, it's something that's coming up. Can you speak, though, to which investor is going to invest in the fund versus the sidecar, and why?
Well, believe it or not, a lot of fund investors, I would say 80% of them are interested in sidecars, sidecar vehicles, because for the reasons I just mentioned, they know that they've already been vetted. These are deals that we like. These are deals that we have high conviction in. And oftentimes, if somebody's putting $500,000 into a fund, they have more money that they're willing to invest. So they're very likely to come in to a sidecar vehicle like this. So it's a large portion. And what we found more than anything is that this is going to be a bigger part of our business going forward. And it's something that's in high demand. And for the few deals that we have syndicated, the demand has been so overwhelming that it's difficult to give a piece to everybody, because in our funds, we might have 300 or 400 people. And when you have a $7, $10, even $15 million deal, those end up being fully subscribed within a day or two. And so there are a lot of investors who end up not participating because we generally do this on a pro rata basis. So we're going to go out to our largest investors first and give them a piece, and then kind of work our way down the reins. But what we found is that everybody really wants to participate, or that 80%. So going forward, even as we're concepting a new fund that's going to be out, we'll be marketing in the third quarter, and then we'll be coming out with it in the fourth quarter. But almost every single deal will have a syndication component to it, so that investors can get a piece of those individual deals as well.
Okay, so just to bring some clarity there for the listener, so you're going to have this big fund that will be purchasing numerous projects, right? And the investors may invest in the fund, and they don't know the exact deals at that time yet, right? They're trusting you all, they're trusting your group, they understand the risk level, those things, the type of fund that you're doing. But then the sidecar is going to be deal specific, right? And so you have this deal you're moving forward with, and then you have a sidecar that's attached to a specific project. Is that correct?
That's 100% correct. And if, I'll give some tangible examples. So if we come out with this fund in the fourth quarter, right now we're targeting $150 million in fund size. And so when we're looking at, from a risk management perspective, about how to allocate and diversify across this fund, this will be all ground up development. We'll have about 8 to 10 deals in there. And there's also what we call a GP sleeve, a general partner sleeve. So those are high margin deals where we are participating in the general partnership. But the other, 8 or 9 deals that will be in this fund, we don't want any more than 10% of a deal in the fund. So if your typical ground up multifamily development deal is $25 million and we're putting $15 million in the fund, that requires $10 million of additional equity as that sidecar vehicle, and investors are participating right alongside the fund in those. But when you add that up, that's almost $100 million in syndication. So the net of it is the fund will have about $150 million in committed equity. Those fund investors will get the first look at those sidecar opportunities, which will be about $100 million. So in all, that's about $250 million in deals that we'll do in that particular fund itself.
Will your fund be 506B, 506C?
506C.
And then something I've learned recently, though, what about your sidecars? Because they could be a 506B then. Is that correct? Or do you all do that?
Yeah, but we operate under the 506C rules, even in sidecars. So, with those, again, that's more, we don't market those per se on a broad marketing, because generally all of those sidecar interest, they get gobbled up by fund investors. So there's no reason for us to broadly market those. And it's usually an outreach by our investor relations department going out to individuals in batches and letting them know about the opportunity. But nonetheless, there's no reason for us to use 506B when we can use 506C. It gives us a little bit more room to maneuver.
Sure. What about just the structure of the fund? And so just so the listener can understand, you can structure them almost any way you can think of, right? But some common ways, I know recently I've heard people talking about just like 70-30 split, or some people call it like a 80-22, like a 80-20 split, then like a 2% acquisition fee or something like that. But how do you all structure that? How do you think through how to do that?
Yeah, so you're talking about fees, and I think there's a couple things. So in our funds, I'll start with sort of the legal structure, if you will. So we have two funds that are operating today, and then one that is on the horizon. And with our funds today, we have an income plus fund, and that's more for the income-oriented investor. That has about a 6.2% annualized yield. And then there's another, call it 3 to 4% of appreciation that we're targeting in that fund for a total return of about 10%. And that fund actually has a REIT blocker in it for tax advantages. But you're investing through an LLC. So that, for people who are investing in non-taxable accounts, the REIT blocker helps with blocking UBTI, and it has other tax advantages, the 20% deduction as well. In our QOZ fund, we do not have a REIT blocker. That is purely an LLC that you're investing in, and that has some great tax advantages. And then in the next fund that we're going to be coming out with, that will also be an LLC, a limited liability corporation, to which investors will get a K1. And I'm not sure if we're going to do a REIT blocker or not in that fund. But you're talking about specifically fees, Whitney, I'll get to that. In our Income Plus fund, what we charge is a 1.25% annual asset management fee on that fund, and then a 10% performance fee. Now, the advantage to that fund is it's open-ended. And so when investors are coming in to that fund, they're investing all of their capital at once, and they're diversified across the existing deals in that fund. So it's a little bit different than a closed-end fund where you commit your capital and then it's called over a period of time. And there's a big advantage to having all of your capital working at once. And that fund is then marked to market on a monthly basis, and dividends are provided on a monthly basis as well. If you don't want the dividend, you can enroll in the DRIP and you can just reinvest those along the way. And then in our QOZ fund, that is purely ground up development. That is also a 1.2, I actually forget, I think it's 1.5 or 1.25. I'll go with the higher number so people don't call me out. It's still a good number. 1.5%, and then a 15% performance fee. And in all our performance fees, and this is there's the thing about this market is it's kind of all over the place where people charge fees. And understand this, what you have to look at from an investor is really compare the gross to net. So you look at what it is at the end of the day. If two investment managers are saying, look, at the end of 5 years, you're going to double your money, right? That's the pro forma, right? Let's throw that out, how accurate those are for a second. But what matters is the gross to net, right? There's always going to be fees in these funds. We have a team of 30 who are working on behalf of almost 1,600 investors. So our fees are the annual asset management fee. In some cases, we do get an acquisition fee. In some cases, if we're structuring a fund, we might do a committed fee. But in fact, this fund that we're coming out in the fourth quarter, we've actually decided to go away from the committed fee after talking to our investors, because they would much rather have the variable cost of an acquisition fee than the committed fee. What a committed fee means is that if you have a closed-end fund and you commit $1 million to the fund, you are paying whatever that annual committed fee is from the day that you make that commitment. So if it's 1.5%, you will be paying that manager $15,000 a year starting on day one. If you look at it from an acquisition fee standpoint, then you're only paying once the manager finds a deal, right? The fees generally come out to the same as long as there's a velocity of capital and the manager is doing their job. If we're doing our job and putting out capital in, call it 2.5 years. But if we're not, then the risk falls on us and not the investor. So that's always a risk of investing in a fund. You commit to $1 million and the manager can only put out, $600,000 or $700,000 and you've paid fees on the whole thing. But the way that we're operating, going forward is we're just trying to create better structures, more friendly to investors and meeting the market demand and continuing on our structures going forward.
No, that's awesome. I appreciate just you elaborating on that, because I think a lot of this is new to many of the, say, newer upcoming operators that are listening, and many investors too that I know listen to the show. I get questions every week about funds versus not doing funds, or single asset funds versus open funds like this. Can you just speak to the investor, though, that's the passive investor that's thinking through maybe the tax implications between, say, your income fund versus QOZ fund or other types of funds? What are a couple of things they should be thinking through as they're seeing more opportunities to invest in funds now versus single asset deals?
Yeah, so we've done a lot of education on this too. We have a blog. We've written over 400 pieces of content, and I would say that our strategy has really evolved over the last couple of years. And one thing that we've fundamentally changed is that we've moved from a buy, fix, and sell strategy to a buy, fix, and hold. Because as we look back, what did we do right? We did our funds did great. They were top decile, top quartile performance, but even the deals that we sold, we couldn't replicate those today. And in real estate, and really any investment class out there, true wealth is built by buying, building value, and holding great assets forever. And so when we're looking at, especially in multifamily, you've seen a huge run up in prices, replacement costs, et cetera. Our Income Plus fund is designed as buy, fix, and hold. Our investors in that are typically accredited investors. They're high net worth, ultra high net worth family offices, registered investment advisors as well. And in that fund, it's a 3-pronged strategy. So we have preferred equity, we have a core plus sleeve, buying existing deals, holding on to a portfolio of really irreplaceable assets. And then we're also have a 20%, what we'll call a frontier sleeve, which is for ground up development. And ground up development is not a build to sell, but it's a build to core. So in that particular strategy, we're building in markets like Phoenix and Nashville, because in those markets, it's nearly impossible to buy. There's so much capital that is chasing deals and paying well above replacement cost. And we just see that the advantage there is to building ground up to penetrate those markets at a better basis than what you can buy for today. And in our QOZ fund, the way that one works is that by law, investors have to be in that fund for 10 years and a day. And that's really a build to core fund as well, because QOZ law requires you to more than double the basis of the investment, which invariably means that we're doing ground up development in that fund. But ultimately, in about 3 years, we'll have a portfolio of Class A properties located in some of the hottest growth markets in the United States. And we'll be holding that for the next 6, 7, 10, 20, even 30 years, depending on how long you want to stay in the fund. So real estate is incredibly tax efficient. But if you're not in it for the long run and you're in a buy, fix, sell strategy, you're flipping deals, you're not taking advantage of two of the most important things of real estate, which are depreciation to shield taxes, that passive income. And in today's world where you have tax rates going through the moon, it's really, really important. And then the other one is the ability to refinance tax-free over and over and over again. And that's something that if you're going to sell an asset and you're going to flip out of these, well, you're not taking advantage of those. And on the flip side of the coin, and I've talked about this a lot, you're paying taxes, so you're reinvesting a much smaller portion of your capital. And then you have something called cash drag, which is when you sell an asset and money sits in your bank and you have to wait, 3, 4, 5 months to reinvest that also has to be included in your calculation of returns. And a lot of people forget to do that. And so the way we've structured like the Income Plus fund is we want all of the money to go in there at once. These are funds that I use, my partner uses. We have almost, I think, $8 million collectively invested in the Income Plus fund. We have $10 million in QOZ. So we have a saying that we create funds that we want to invest in and manage our wealth in. And, that's exactly what we do.
For the operator that's listening right now, that's fixing to pursue their first fund, what are just a few things, Michael, that maybe you wish you had known when you all did your first fund?
I would say educate your investors on a buy, fix, and hold strategy. And it's I listened to somebody in Chicago. His name will come to me, but I remember years ago when he's sort of a Chicago icon. His name is Dan. Oh, I forget the last name. It'll probably pop in my head in a minute. But he gave an example many years ago, and he said, "Look, we used to be in the buy, fix, and sell business, and what we realized is that we were making great IRRs, but we were building irreplaceable real estate." And he gave a couple of examples, and he said, we built a multifamily residential tower in San Francisco. And the numbers he gave, he said, look, we bought it for $10 million. We put $5 million into it. We sold it for $22 million. And he said, the real money was made by the person who bought it for $22 million because, at the time, this was 10 years later, we all know what's happened in San Francisco, but it's really a story about irreplaceable real estate. He said that property today is worth more than $100 million. And you can think about that. And he's like, so what I took out of that, and it was really sort of profound at the time, is that when you've already mitigated the downside risk and you have protected investors' capital and you've maybe sent some money back through refinancing, maybe not all of it, you should be holding those assets. And you have to educate investors on the difference between IRR and multiple on invested equity. And real wealth, again, going back to the beginning and tying this together, is made through buying and holding great assets forever. It's not by buying and flipping out of great assets and letting the next person do that. And you can have, countless examples. And I'm sure there are people going, yeah, but you can never, go broke taking a profit. Yeah, I don't know. That saying is great, but it's not actually true. And you can apply this lesson to the stock market, to real estate, to everything. And there's the old saying that I subscribe to, which is time in the market is far more important than timing the market. So as long as you have the right amount of leverage on these deals, it's great, irreplaceable real estate, you've managed your risk, you should be holding these deals and educating your investors on why it's important to hold these deals, because deals that are making 2x, if you hold them for another 5 or 6 years, maybe they make 4 times on your money, 5 times, 6 times. So that is a lesson I would say that everybody needs to learn. Stop marketing IRR and start marketing the wealth that you can create for investors, because that's what matters.
So well said. Love that. That's incredible. Did you call it IRR versus, did you say multiple invested equity? Is that, did I hear that?
Yeah, multiple on invested equity. And that's something that, years ago I was educated on. I think when I first came into the investing world, I was at a conference and I heard a manager talking about that and saying, look, you can't really measure IRR, right, in terms of wealth. If somebody said, give me $1 million, I'll give you a 15% IRR, you don't know what that means, right? Because it's a time-based function. So it could be that you invest $1 million on day one, they give you back 30% of your money 4 months later, they give you back 30% of your money 15 months later, and you have this giant IRR, but then your multiple on invested equity, which is simply defined as if you get a 1.5 multiple and you put in $1 million, that means that you've made $500,000, that 0.5 on your money. That is measurable. IRR, on the other hand, is time-based. It has a purpose. It's the best way to measure for funds that have erratic flows of cash flow, but you have to use them in balance. And a lot of times people are looking, I don't want to invest in that because it's only 11%. Well, let me tell you something, 11% over 10 years is a lot of wealth. And I would challenge investors, look at your portfolio and say, have you really ever made 11% over annualized compounded rate over a 10-year period. Because if somebody told me that, listen, I've got an investment that is risk-free that will make you 9% a year compounded annual over this period, I'm in. It just doesn't exist out there. And so, there's a lot of this chasing the 15% IRR, but you're selling it, your taxes, your cash drag, et cetera. And I think you're much better off going into a lower IRR or annualized return, right? And looking at the multiple, something a little bit lower risk, but keeping your money working for the long run.
You talk about, and I think it's so smart too, just the importance of educating your investors on this, right? And so many investors, I speak to every week, and they have many basic questions. They're wanting to get into this space. Maybe they've been in the stock market, they've been in other things, and they're trying to learn about syndication. What are just, we're almost out of time, but what are a couple tips for the best way to just share these thoughts with investors to really help them to understand why this way of thinking is so important?
That's a great question. So we have a saying, when you're explaining, you're losing. But the reality is that we consider ourselves educators, and we want people to fundamentally understand this, because this is the way that we invest our own capital. This is the way the most sophisticated investors, family office, pension funds, endowments, invest their own capital. So there is an education component to this to get the marketplace to kind of rethink the way they analyze, they view. And so we've written more than, 400 pieces of content on this subject. And everything I talked about here today, I've written something on it, or somebody in our firm. And we send out an Origin Insights newsletter bi-weekly with new articles on there. You can subscribe to our newsletter. You can go onto our website. We have everything from Education 101 in real estate, talking about IRR and multiple, to what is core plus real estate, what is opportunistic, what are fees, what is a reasonable fee structure, to even how to vet your manager. And it's kind of interesting because, this is like a step-by-step guide. I think I wrote it, 5 years ago, but we get calls all the time where people are using this step-by-step guide and asking, the questions that they really need to ask to understand whether or not they want to invest with us. And it's great to see that is actually a tool that people can use in something tangible. So educating is it's in our DNA, and something that we feel really passionate about, and sort of opening up this market and making sure that people know what they're getting into. And a lot of this is born out of the fact that I've made my share of investment mistakes, and I don't have to sit here and act like I've never done that in my life. Pre-Origin, one of the reasons that got me to Origin was that I sort of got, it was sort of 2 steps forward and 1 step back all the time. And I got together with my partner. We created a team. It's a much better environment when you have a lot of smart people making decisions out there and seeing a lot of deal flow. And so it's really something that my partner and I have always felt strongly about, is like, hey, let's help the individual investor, even the high net worth, the ultra, high net worth, really take advantage and get the greatest benefits of real estate. So by us writing about this and educating people, whether or not they invest with us or others, they're just going to be smarter investors. And I think the entire market has benefited from the educational resources that we've created.
For sure. Well, Michael, even today, you've provided so much educational content just in 25 minutes or so here. Very grateful for your time and your experience. Unfortunately, we are out of time. But and listeners, I would encourage you to go back and listen to Michael's previous show, where I ask him all the typical questions, that we talk about in just daily habits, or how they're meeting new investors and things that's contributed to his success. But I'll also ask you, Michael, how do you like to give back?
So I'm involved, I think, from a real estate perspective, from a real estate perspective, I got my master's in real estate from DePaul, and I've been a sustaining board member there for the last 10 years, at least. So, that's one way I give back to the real estate community. I've definitely mentored many DePaul students coming through that program as well. And then, from a personal standpoint, my wife and I have a donor advised fund, and we can, we donate to a multitude of charities, and it's just, the world we live in. And I think it's important to give back and continue to do that.
Michael, again, grateful for your time and just going through just what a fund is today. Whether you're a passive investor or whether you're an operator, I know this show has tons of value for you. And Michael, just how you structured the fund, whether it's your income plus fund versus the QOZ fund, and I mean, numerous aspects of it there. Grateful for that time. How can listeners get in touch with you and learn more about you?
Well, they can go to our website, origininvestments.com. We make it very easy. You can download our documents there. You can check out any of our funds, learn about us, learn about our track record, our history, and you can also connect directly with one of our people in investor relations, one of our team members there. So very simple. And then my email address, if you want to get in touch with me directly, I can always direct you to the right person. It's michael@origininvestments.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.